You'll introduce all three team members, and I'm going to start the call.
Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm your host for today's webinar. Thank you so much for joining us today for this Lunch and Learn for March. Risk management is an integral part of managing your wealth, and today you're going to hear from three of our experts on this topic. First, Susanne Wickham Cook will talk about personal insurance and some of the things that are impacting us all regarding that. And then Iris Turner will share some insight on commercial insurance, which business owners will find particularly helpful. And then Graham Wickham will provide some good information on other types of insurance, as well as managing risks with your investments. As always, there's going to be a Q&A session at the end of the discussion, so please make sure you get your questions into the Q&A section of the chat box, and then I'll make sure all of our presenters get those questions and can provide some answers for you. And just a reminder that you'll see Graham's calendar pop up from time to time during the presentation, and if you'd like to schedule some time with him or anyone on our team, please click on that calendar when it pops up and select a time that works best for you. And now I'm going to turn things over to Graham to get us started today. Graham?
Hey, thank you, Stacy, and thank you for all of our attendees. I'm actually out of town, but we have the rest of the team in the office. Some of my team members I brought on board for the call today, as Stacy introduced Susanne Wickham Cook on personal and commercial lines coverage, as well as Iris Turner for commercial, talking about the important risk management things that we need to address in terms of our own personal lives, as well as if you're a business owner from a commercial or a business standpoint. And then I'll wrap up the call. I'll come back and wrap up the call, as Stacy mentioned, about some other tools in terms of risk management, maybe used with estate planning, and how to think about risk in your investments, maybe some strategies to prop up the accounts if you might in these environments. But let me go ahead and jump in. I want everyone to keep in mind that everything has risk. So we have to define how much risk we're willing or comfortable to take. So insurance is an essential risk management product. It mitigates the risk that you're taking. It transfers risk to, let's say, an insurance company to help manage that risk for you. Insurance in general is meant to indemnify or make us whole, not profitable. So when we think about risk management, not just from the investment side of risk management, we're thinking about it from the risk or the insurance side. We're thinking about auto insurance, homeowners coverage, your business coverage. What role does life insurance or health insurance, disability, long-term care, what roles do they play for you in terms of mitigating risk against loss? And last but not least, we got to think about risk management with our investments. The traditional risk management tool is allocations between stocks and bonds, but in such a high inflation environment, it could be pretty challenging to go to the bond market, which is actually under a lot of pressure right now to mitigate risk when they're actually down on average more than the indices, let's say the S&P 500. But I'll get into that much later. I want to go ahead and introduce Susanne. If she could, go ahead and pop online and talk to everyone about personal lines and some risk management strategies there.
Hi, everyone. Thank you for joining us today. My name is Susanne. So for personal lines and referencing just generally today, automobile and homeowners, we are looking at currently rates possibly going up for both. Unfortunately. So looking at the automobile, reasons that the rates may be increasing with that is the cost of repairs for vehicles. As vehicles are getting more electronically advanced, that does cause repair costs to be higher. Also, the shortage of the parts in order to repair the vehicles. It's taking longer to get the parts in, which is causing people to have rental cars longer, and it's also the parts are more expensive. So that's definitely a factor, as well as labor shortage. I have been hearing that there's body shops at very popular dealerships that are having to close because they just don't have the manpower there to keep it going. So all of this stuff is playing parts in rates going up for the insurance companies because they're having to pay out more money for all of those factors involved. Another factor for autos is legal costs, people seeking legal counsel more than they used to. So that also impacts the insurance companies having to pay out more money, which ends up circling back around to the consumer. So for homeowners, on that side, we are seeing the insurance companies increasing the dwelling amounts. Usually they were between 6 and 8% increase every year to keep up with inflation, and now they are going up 10 to 12%. But that is giving the homeowner protection. So since building materials are going up in cost, if you did need to replace materials on your home, roofing, or if there's a fire, those materials are going to cost more. So that's why the insurance company is increasing everyone's dwelling amounts a little bit more than normal moving forward. Another reason is there's a labor shortage also that comes into play for property insurance as well. So there's higher wages that the contractors and people are having to pay out, which is causing the claims to be more expensive. So the insurance company is having to pay out more money. So those are some reasons for the rates possibly going up. I would, from a risk management point of view, to cover yourself, be sure your automobile is covered. You have the right coverages. You have all of your drivers listed. Homeowners, be sure your dwelling coverage is in line with the current amount of building materials on what it would replace it if needed. And also, if you could get an umbrella policy, that is definitely going to give you the protection that you need to protect your assets, your home, your auto, everything that you've been working for to protect. So that's my input for this month on risk management and why things are going the way they are for a little while at least. So,
Hey, Susanne, can you shed a little bit of light on when we're thinking about risk management with your home and car? I know Georgia, the Atlanta metropolitan areas, is one of the worst traffic, I think, in the United States. I hear that 1 in 10 drivers are or underinsured. So what role should that play when someone's looking at their insurance or trying to mitigate risk with their own personal policies?
You should definitely, the state of Georgia does not require uninsured motorist coverage. It's not a required coverage, but everyone should always purchase uninsured motorists because there are so many uninsured drivers driving around out there. Some don't purchase the insurance on purpose or just to get a tag, and others, their insurance may be canceled and they don't know about it. And then when they're in an accident, they're considered an uninsured driver. So it is very important to protect yourself with the uninsured motorist coverage. Yes. Thank you.
Yeah. Thank you.
Anything else on that?
I have another question. How often should someone be looking at their personal lines coverage, not just their home and auto in terms of limit or remarketing? Because I know when we were in the midst of the pandemic, we were staying at home. We weren't driving as much. So you really saw what credits or reimbursements going out to personal lines policyholders for their auto, but we haven't been seeing that with home. How often should someone look at their home and auto coverage? And why didn't we see any, discounts or whatnot for homeowners coverage?
The reason they gave automobile credits is because people were not driving as much. So the homeowners was different. People were staying home. So they really didn't give you any credit because if anything, you're using your home more than you were because you're not going to the office every day. So the insurance companies were viewing it as there was less cars on the road, trying to help people out because a lot of people were out of work or, they couldn't go to work because the employer was requiring people to stay home. So the insurance companies were trying to offset customers' expenditures by giving that credit. And not all of the insurance companies did participate in that, but I know that there was a good amount that did. And you know, your most personal lines auto, you can either have a 6-month policy or you can have a 12-month policy. I definitely think you should look at your coverages to be sure everything is up to date and accurate once a year. If you want to shop your rates to look and see if you can find anything better for yourself, I wouldn't shop it more than every 3 years though, because shopping it every single year, the insurance companies like to see consistency. They like to see you making your payments on time. They like to see that you can keep a policy for 3 years and your payments are on time and see a good household, management going on there. So that's what I kind of try to talk to my customers about.
Yeah. Thank you, Susanne.
Yeah, you're welcome. So I guess Iris, would you like to help us out on the commercial side?
Of course. Thank you. My name is Iris Turner. I am an insurance producer here at Wickham, and I specialize in business insurance. So what I'm talking today is about the workers' comp area after all the pandemic and what is called the Great Resignation, since a lot of people quit their work and their jobs. So a lot of companies, employers have seen that they don't have the staff to work to do their daily job. So the one thing that after all this, they're adjusting to provide safety, just make sure the employees feel safe coming back to work. They also are providing light duty jobs, meaning if they cannot come back to the original job because virtual schools or any other issues, they are opening up other positions within the on the business so they can do a different kind of job and still helping. They also have asked the supervisors or managers to kind of take a hand-on approach, meaning so the employees feel that they're treated well, that they are being taken care of. So they're kind of trying to change a little bit the protocol in the business to kind of get everybody to kind of feel safe about coming back to work. Also, there are some pros and cons to some employers have been willing to pay claims that haven't been covered by the insurance companies for any reason, and that's something that we want advice, but you have seen that on the business. You don't want to create a precedent of paying claims that are not covered on a policy, so you should not do that. You just follow the law and what the insurance company decides. There are also other issues about hiring people with less experience just because they are short staffed. For example, a trooper that doesn't have experience, and then he creates a big accident because the lack of experience. So there are a lot of things that an employer needs to watch, and just really don't take a decision that is going to create issues and problems later on. The other topic I wanted to talk about was on the business insurance, the lines of business that we see some decrease or some kind of rates. If they have decreased or they have stayed normal, if some have been increasing, and like Susanne, the ones that have been increasing are the business auto and workers' comp. And the reasons are really because we're kind of going back to the normal. Employees are going back to work. People is driving more. The supply chain disrupt also created a problem on the parts for the vehicles to be repaired. So the insurance company has to kind of increase the rates to kind of get that money back, unfortunately. So us, the clients, are the ones kind of paying the consequences on that. The same with workers' comp. More employees are out working again, so there are more falls, more claims. There are tons of ways that, at least for the business auto part, that you can try to decrease the rate, or at least not the rate, but decrease the premium, asking for higher deductibles, asking for maybe a full payment instead of installments, asking for a paperless way. So, they give you discounts for kind of making it easy for the carriers. So there are a lot of, ways that you can still try to manage that increase on premium, asking your agent to, help you, to give you ideas. Also, another way is the auto payment, when they do an EFT, that they take the money that's taken from your account instead of you mailing the payment. All that gives you discounts. So, well, I hope these topics are interest for you. And if you have any questions, just please feel free to ask. And I'll pass it on to Graham again.
Yeah, thank you, Iris. I'm always good for a good question here. How important it is for a business to maybe have, I guess like maybe a class or a course for the employees to help them understand risk, and you kind of field mitigate risk where they can, meaning, be cognizant of risk in their environment, so maybe they can lower some losses of claims and whatnot.
Yeah, we usually, OSHA recommends training and courses online. There are, offerings of persons or people that do training courses, and they can come to your office and provide classes to your employees. And, it's always, having the good equipment, for constructions, the hat, the hard hat, the glasses, the hard boots, having a monthly check or a weekly check for all your tools, ladders, all the things that can be at risk if they are not, maintained, have the maintenance that they need to have. So all those are always recommended. Yes, I mean, I would recommend either if you can afford a safety manager or somebody that comes and give you the classes, just log into the OSHA website. It gives you so much material, and also even the insurance companies too. They will provide you any material that you need just to know what are your, what the advices that they will give you, so you kind of get your employees in the safety side, and just inform them what they need to do to make sure that they don't that a claim doesn't happen.
Right, absolutely. Thank you. And I know that's something that we do as agents for our client, to have those conversations with the principals about risk management strategies within the workforce. Not to mention at home, right? With the Susanne on the auto homeowners coverage. Making sure that you have protections in place if you have children running around, being active, trampolines, diving boards, certain types of pets or pets in general, can all play a role in terms of risk management. And I think also at the same time can keep our costs down, right? If we're better managers of our risk or cognizant of our risk, I think that increases the odds that we can keep our premiums down, or at least lower for longer than if we're not trying to mitigate risk. Is that a fair statement for both of y'all?
Yes. That no losses or a clean loss run, which is called like a history of claims, will always give you a discount on your premium. So yes, the less claims, the less accidents, it's always going to be a good thing.
More cost effective, yeah.
Great. Thank you. Well, I'll go ahead and jump on my side so we can keep moving forward today. Let me jump in and talk about some additional coverages. I'm going to expand my screen. My eyes aren't as good as they used to be. But when we think about additional coverages, we've talked about the business coverage. We've talked about the personal, like home and auto type coverage, umbrella, renter. If you have a renter, if you want to rent a house, you might want to think about rental coverage, pretty low cost coverage, making sure we add uninsured motorists. But I also think when we're thinking about estate planning, we're thinking about managing our assets, we want to think about life insurance. What role does that play? The odds are you're going to need more life insurance when you have children, you got mortgages on your house, so on and so forth, than you are late in life when you don't have the children at home, or maybe you don't have the mortgages, maybe you need less insurance. So that can be a fluid role within your estate planning role or risk mitigation role. Then the types of insurance, you got term insurance, you got cash value insurance. Term insurance is going to be your lowest cost. So you buy it for a period of time, like 10, 20, 30 odd years. And then it goes away. It doesn't build any cash value. But life insurance, not just from a risk management tool, but also an effective retirement income tool, maybe a college planning tool. You can use cash value life insurance. So cash value life insurance is basically having a life insurance policy, but you pay extra, and that extra goes into these sub accounts or separate accounts that build based off an index or a stated interest rate. And if used correctly and not lapsed, and we're happy to always have a further discussion with anyone on this, they can be a very tax-free distribution to help subsidize retirement, maybe a goal, maybe college costs. So just food for thought on that. While you're working, the odds of you needing disability are high. The percentages are very high that you could be affected, not just on the job where workers' compensation would come in play, but maybe if you're not on the job, maybe you're working around the house and something happens. Well, you could have disability come in there, and that would cover some of your monthly costs or bills. But after you stop working and you're retired, then we want to think about long-term care. So you're taking one cost, you lower that cost, maybe go to long-term care. 40%, there's a 40% of individuals who need long-term care are somewhere between 18 and 64. The average cost of long-term care assistance at home on a national average is just over $4,000 on a monthly basis. So imagine if you're in a full nursing care facility, let's say in a private room, that could be $6,000, $7,000 plus on a monthly basis. How are you going to pay for that? Are you going to lower your spouse's standard of living? Are you going to rely on the children? What are your sources to pay for the long-term care? Again, I'm not a big fan of being insurance rich. We just need to be risk management wise when we're thinking about using these type of coverages and when. So a lot of these, it's not the fact that you will you need them, but the idea of insurance is when you need it, it's there to help mitigate from a large financial loss. Of course, we all know about health insurance. If you can pick it up to your company, great, or you got the exchanges, or when it's open enrollment, you can go into the open market for that. And then annuities. Annuities, are insurance policies originally designed to pay out an income stream that you can't outlive. But the reason why we use annuities today could be a multitude of reasons, right? It could be used to mitigate risk. Let's say you buy a fixed annuity. You don't have any downside risk, only upside opportunity based off an interest rate, or if it's tied to an index, say the S&P, you would appreciate with some sort of upside performance, but not all. It's a give and take. So it can lower risk and be very tax efficient from a tax deferred standpoint. From a variable standpoint, maybe you want more upside, but you like some tax deferral. Not always is it going to protect your money against loss. That's the variable side of that annuity. But if you buy certain riders on these products, like income riders or added death benefit riders, they can be a life as well as an additional income stream that is guaranteed that you could budget on as you're approaching or in retirement. So, annuities can play a role if you're wanting to be very conscious of risk, maybe lower risk. You want to provide a guaranteed income stream for you. Maybe we want to be thinking about tax deferral. That can be a way for taxable dollars that go into an annuity. So there's a lot of ways to mitigate risk outside of home and auto, or your business, you can do it with these tools. And everything we're talking about today is part of an effective wealth management plan. Wealth management is not about investments necessarily, or the right side, or your retirement accounts. It could be what risk management strategies do you have in place, as well as estate planning. If we think about it from an investment standpoint, and Stacey, I know I'm going a couple minutes over before Q&A, so bear with me. But I think this is a really important thing to touch on. We teach multiple, retirement planning classes and courses in local schools and universities around town. And the one thing I really try to get out to everyone is everything has risk, right? Every investment, anything has risk, and we have to define those risks, right? So it might have market risk. Let's say you in Microsoft, it goes up and down with the market, but it's not necessarily an issue with Microsoft. Business risk, let's say a company has a product and it's not in favor for one reason or not. Apple had an issue with that years ago. No one ever thought they would produce anything better than the iPhone, but they forgot about maybe the ecosystem. So that could be business risk. It's down because maybe a product cycle. Interest rate risk, very much what we're in right now. Rising interest rates, that's negatively affecting bonds. Older bonds are going down in value because newer bonds or fixed income that's being issued is coming out with higher interest rates. So they're selling older to buy the newer. And right now in a rising interest rate environment, it's very challenging for bond exposure. Inflation risk, your cost that your investments can't keep up with inflation. Inflation is basically 8%. Let's just call it 8. Could go a little higher, maybe going lower. But right now, any return below, let's say 8%, you're losing money. Liquidity risk, you can't get out to take advantage of other opportunities. Maybe it's fixed in or opportunity risk. Again, can't take advantage of other opportunities. But currency risk, our currency is very strong in the United States, and that's good to have a good, strong currency policy, but it's so strong and it's too strong. International currencies or international consumers might not buy our goods because it costs too much to buy our goods when they have to be in dollar terms. Now, outside of that, you can allocate to different sides of the markets, and diversification, stocks and bonds, international, domestic, small cap, large cap, different sectors like value or growth, or let's say we go industrials to financials. Then laddering. When we're thinking about bonds or we're thinking about CDs, how do we protect ourselves against rising rates? How do we mitigate that risk? Well, we can do ladder. We can ladder out the maturity. Let's say bonds. We buy bonds that mature in 1 year, 3 year, 5 year, 6 year. I'm just throwing out random numbers, but you're always having money coming due to take advantage of rates or buying bonds or CDs at higher rates as rates increase, which we're in that environment right now. And last but not least, good old fashioned dollar cost averaging. Sometimes out of sight, out of mind. I'm not saying being ignorant, but out of sight, out of mind is a great way to manage your accounts. If we're making a consistent contribution into our investments every month, let's just say $1,000 a month, when the market goes up, you're going to buy less of that investment at a higher cost. But when the markets go down and you consistently doing, you're buying more at a lower cost. Doesn't guarantee that you're going to have positive returns, but certainly sets you up for future returns, just having a lower cost basis. So, I think that's the primary things from an insurance, from a wealth management side or estate planning side, all the way to your investments, how we can mitigate risk. Stacey, do we want to open this up to questions?
Yes, we would. I have gotten a couple of questions in, and I think this first one is directed to Iris. And Iris, someone wants to know that as an employer, can they pay workers' compensation claim even though it's not covered by the carrier? They just want to help their employee.
No, my advice will be no, just follow the law. If the claim wasn't covered by the insurance policy, that needs to stay like it is. You don't want to create a precedent of paying claims that have not been covered, and then you always will be paying claims to other employees that know that you have done that in the past. I would recommend what just Graham was just talking about. If it's in a way that you want to help employees or your team, just ask them, offer them additional insurance, life insurance or disability insurance, health insurance. I mean, I think I'm sure there are options there for employers on that part with their employees instead of paying workers' comp tax.
Okay, thank you. Susanne, this is for you.
Okay.
This viewer wants to know what they can do to lower their rates or at least keep them from rising.
Okay. I would say just be sure that you are reviewing your coverages and your policy and try to maximize as much discounts as you can. Discounts do, help, which means multi-policy discounts, pay in full, any defensive driving courses you can take. On the homeowner side, you can increase your deductible, get security system in the home. Just try to maximize your discounts, and you can speak to your agent about that, and in particular which company that you're with to see what is available.
Okay, thank you. Another one that just popped up for you is they want to know if they're going to be seeing rate increases every year. I want to know too.
Let me get my magic ball. No, I don't know. Usually they don't do it every year because they do have to, the insurance companies do have to apply for the rate increases with the state. So, of course, I'm sure they want to increase every year, but they're not always approved because they do have to apply to the state for that rate increase. So on the average as a whole, I would say no, not every year. So.
Okay. Graham, what risk management moves should I be taking with my investments in this economic environment?
Well, I think you have to look at your overall exposures, right? And you have to have a gut check. We talk about different levels of risk. You got to define what risk you're willing to take. What's your time horizon? Meaning, when do you need to pull funds out to meet certain goals? As retirement, within the next 6 months to 1 year, and you're going to need to pull from your accounts. Maybe you want to be a bit more cautious, maybe have that cash set aside in a very safe non-investment account for 6 to 1 year, minimally 6 to 1 years worth of the income needs you need. I think also making sure you're allocated correctly. You're not overexposed to bonds, but doesn't mean bonds don't have a role, but we have to appropriately understand why we own them. If you do it that way, then you can always manage through whatever the market throws, because we're always going to have in favor and out of favor.
Well, with that said, are bonds and fixed income still good risk management tools?
They can be. It might not be something that you want to overweight in, but as things are in favor and out of favor, I just mentioned, bonds are out of favor right now, but there'll be a day when they're in favor. Stocks are in favor, but the day they're out of favor. So yeah, you might underperform today, but tomorrow it might outperform for you. If you buy bonds like municipal bonds, they can be tax-free income. And if you're at a high tax bracket, that might be very attractive. So it might be worth taking a little bit of pain today for longer term gain and preservation, as well as just good old fashioned lowering some volatility in the account. But it is reasonable to expect that stocks are going to outperform bonds for the foreseeable future, just with added volatility and risk.
Okay. Well, thank you so much. And thank you so much to our viewers today. We hope you found a lot of value in our topic today. There was certainly plenty of valuable information packed into this Lunch and Learn. As you all know, we post our most current information on our social media accounts, such as Facebook and LinkedIn and Instagram. So please remember to check those out regularly. And we also post our weekly wrap up. So please follow and like to make sure that you stay on top of that latest and greatest information. Also, our website is a good source for all of the information we're trying to get out to you all. I hope everybody has a great afternoon, and we'll be looking forward to seeing you next month at our next webinar. Thank you so much.
Take care.
Thank you.